So it was really an honor to be here today. We've been waiting for this day for a long time. The Nasdaq Hashdex relationship goes back many years. We were just reminiscing before we met the team during Brazil Week about 6 years ago, and so I know a lot about the Hashdex crew, but that's where, Samir, I'd love to be able to have you kind of tell your guys' story in terms of kind of looking back since 2018, how you guys formed, your global presence, and really kind of what led you guys to launch and everything.
Oh, sure. 7 years in crypto is an eternity, right? If you remember back in 2018 when this all started, so I've joined Hashdex in July 2018, and the infrastructure for crypto wasn't there. We knew that the thing that got us together is this belief that crypto is a new asset class, so it's something that's going to really transform our society, but also that crypto is way bigger than just Bitcoin, right? And we wanted to create an asset manager to build this bridge between the traditional financial markets and crypto, bringing crypto as a new asset class beyond all the speculation and all the frenzy that we saw back in the first big bubble. It was not the first crypto bubble, but I think was the first time that everyone heard about crypto in 2017. And so we decided to create this company to be this bridge. And we wanted to start an asset manager, and we wanted to start with a market exposure. And the big challenge was how do we define the investable universe, right? So which assets should we invest in? Let's look for a benchmark. There wasn't a benchmark, right? So I think the big vision back then was to create this benchmark. So we founded the company back in 2018 to build this benchmark, to build investable products that really we would like to invest in, and that any investor, from a big institutional sovereign fund to small retail investors, could have access to. We wanted to build a business in the US, right? So remember, we set up the whole infrastructure to convert that fund into an ETF in the US. We found out that the regulatory environment here was just not there. It was very far away from it. So we expanded the company outside of the US. So we started with a Cayman fund, and then we saw in Brazil that the regulators were very open-minded to having a regulated asset manager offering crypto services, because the demand for crypto was huge in Brazil. The Brazilian investors, they're really tech-savvy. They like investing in technology. The adoption in crypto in Brazil is huge. But also there was a lot of scams back then. And the regulators saw this as an opportunity, right, to bring regulated products and help protect investors instead of just pushing away the innovation. So we set out the business in Brazil. We had a significant success in Brazil. And we kept looking for a partner that could join us in this effort of creating a benchmark. That's when we met first time in 2019, right? Yeah. So yeah, Hashdex is now a global crypto-focused asset manager. We have presence in Latam, in Europe, now in the US, expanding our presence here in the US. We have $1.4 billion in assets under management. That really depends on the day, right? It's crypto, so it can be 20% up or down from that. We're the largest independent asset manager, ETF asset manager in Brazil. So it's a big position. We have the largest crypto index ETF globally. Our flagship product is the Nasdaq Crypto Index strategy that we have available in multiple countries. So this is a little bit about the Hashdex, and we're, like Marcelo said, we're very excited to finally be able to bring this type of product to the US, and we're really excited about what's going to happen over the coming years here.
And you mentioned a little on the regulatory side of how we know that's definitely been evolving in a journey kind of over time, and just really over the last 6 months, we've certainly seen a lot of kind of shift and evolution there. I know you guys have been involved in kind of different engagements around lawmakers really working towards becoming, working on a constructive public policy landscape for digital assets in the U.S. Given this backdrop, what do you see? How do you see this impacting the investment case for Bitcoin and the wider landscape of digital assets?
I think this is transformational for the investment case for crypto overall. If you think about it, in the last 15 years, crypto has been growing mostly outside of the US, mostly despite the US, in emerging markets. So really like the largest capital market in the world has kept crypto outside of the universe, right, outside of its realm. So what we expect to see now with more regulatory clarity is that this technology is going to grow here. And when we look at looking forward, there's just so many applications. We have Bitcoin, of course, as this emerging store of value in a moment in which the demand for store of value is growing, right? And in which even the US government is seeing Bitcoin as a decent store of value. So that reinforces the thesis, and that's probably going to accelerate it. So in our thesis of Bitcoin as a store of value, we would imagine that the US would be the last country to adopt, because we have the world's reserve currency here, right? So why would I, promote a competitor? So we have Bitcoin specifically has been facing a great moment now with the adoption and maturity of the US government, especially the Treasury Department. But when we look at these smart contract platforms, so there's a lot of different applications we can build on top of smart contract platforms. And one very interesting application that I think is probably going to be the killer app, the one that we're going to be using on a day-to-day basis without knowing that it's crypto necessarily, is stablecoins. So stablecoin has been seeing huge exponential adoption in emerging markets because it's just easier. It's the easiest way to have access to the US dollar. And this technology has been mostly like growing outside of the US, but now with regulatory clarity, we could see stablecoin adoption in the US. We could see big banks issuing stablecoins. And so trade finance happening over stablecoins, payments happening over stablecoins. And over time, we're going to have more and more of our balance tokenized. Instead of having like in the traditional checking accounts, we could have in stablecoins, in our digital wallets, in our cell phones. And that's the beginning of like a big trend that people call tokenization, right? So the tokenization of the economy, I think it starts with stablecoins. So I think those are the two things that we're really tracking and excited about. Is first like how the investment thesis for Bitcoin is maturing now with this administration, but also how regulatory clarity would bring stable coins to the US, and that's going to be like a huge killer app for crypto.
Lindsay, I'd love to turn to you. So Lindsay's our lead research analyst for the crypto sector for the index business. And as we've been looking at crypto as this emerging asset class, there's been demand for what we've been calling institutional quality benchmarks that can track the performance of the asset class. But since such a low barrier to entry and creating all these digital assets, there are thousands of crypto assets that are out there. Like, how does the Nasdaq Crypto Index kind of sift through all these tokens in order to determine kind of what constituents we have in the index?
I'm happy to dig into that question. I think first it would be useful to take a look at the landscape of the Nasdaq crypto indexes. So the Nasdaq Crypto Index, or the NCI, launched in 2021 as Nasdaq's first digital asset index offering, and today it is Nasdaq's flagship crypto index. It is designed to track the landscape, international landscape. It's also tracks the performance of a diverse basket of USD traded digital assets. It's designed to be dynamic and broadly representative of the market. The Nasdaq Crypto US Index, or NCIUS, is very similar to the NCI. It shares a lot of the same design criteria, except its eligibility criteria has been altered so that it follows US regulation and standards. As you can see, we have 7 single asset indexes as well, and all of these are reconstituted, rebalanced on a quarterly basis. And if we move on to the next slide, this is a closer look at how the eligibility criteria works. So the process starts with the box on the far left. Every quarter, we look at a universe of digital assets, and then you can see there are 5 main steps, the criteria that they must meet, followed by an additional market cap assessment that results in the final constituent. So let's take a closer look at those. So the first thing is an asset needs to be supported by at least one core custodian. So core custodians themselves must meet their own rigorous criteria around processes, policies, infrastructure, secure practices, and much more. We currently have 6 core custodians that have met this criteria and are considered core custodians for NASDAQ. Next, an asset must be traded on at least 2 core exchanges. So just like custodians, exchanges have their own criteria that they must meet around infrastructure, proper licensing, policies, procedures, and we currently have 6 of those as well. They do contribute data to the indexes, and the first 2 rules are really just meant to ensure that an asset has achieved kind of a critical mass of institutional-ready infrastructure. Next, an asset must meet a minimum liquidity standard. So an asset's median daily trading volume must be no less than 0.5% of the asset with the highest median daily trading volume. And this is really just meant to ensure that, or improve the investability of the index, ensure that there's sufficient liquidity. Next, for the NCI, an asset must be eligible for listing in an ETP on specific European exchanges, SIX and Xetra, as of a certain date each quarter. So it's important to note that this is where the NCI and the NCI US differ. The NCI is connected to this European exchange criteria, while the NCI US actually replaces this step with US-specific criteria. So while they share so much of the same eligibility process and overall design, they do differ here, and that allows them to kind of evolve on different trajectories. Finally, an asset must have free-floating pricing, so it cannot be pegged to the value of any other asset. And once an asset has made it through these 5 steps, it's considered eligible, and from there, there's an additional market capitalization criteria applied. So an asset's market cap must meet or exceed 0.5% of the total market cap of all eligible digital assets. And this results in the final constituents. And also, I should mention that for both liquidity and for market cap, there's a slightly lower threshold for existing assets. They must meet 0.25% as opposed to the 0.5% for newly incoming assets. So just for some context, the last reconstitution and rebalance that we had was on March 3rd. The NCI has 9 constituents that went through this process and made it through. The NCI US has 2. And this process repeats every quarter. Yeah.
Thanks. And can you talk about its kind of just what differentiates this in terms of from the methodology, what makes it stand out from other index approaches?
Yeah, absolutely. And if we go, yeah, perfect. So what really makes the NASDAQ Crypto Indexes unique is the design of the eligibility criteria. It considers many different factors, many different attributes of the assets, and in particular, the core custodian and core exchange rule is really unique because it's a whole secondary criteria that those organizations must meet and that the index is connected to. Also, it's important to mention that there's no cap placed on the number of constituents in the NCI or the NCI US, and similarly, there's no cap placed on how they're weighted. They're weighted according to their free float market capitalizations. So really what that means is that these indexes expand and contract solely based on how an asset performs against the eligibility criteria, which is pretty unique. So this slide here, we can really see an example of the NCI criteria in action. So starting with that purple bar over on the far left, that represents the entire universe of digital assets that are considered. So we have over 1,200. And then you can see as it walks from left to right through each step of the criteria, you can see how many assets made it through. So that first bar, you can see we're down from 1,238 to 1,116 when they go through custodians. And then the next bar is exchanges. So just within those first 2 rules, you can see how dramatically everything is filtered, really. Next up, we have further refinement in the liquidity rule for the NCI, the sufficient ETP listing criteria, then free-floating pricing, and then we end up with these 9 constituents after the market capitalization assessment for the NCI. So hopefully that provides a little bit more context. We have all this documented in detail in the Crypto Indexes methodology, which are published online. We also produce overview decks with more charts and graphs and information like this on a quarterly basis. So I encourage anyone who's interested to check those out.
All right, thank you, Lindsay. So Samir, turning back to you on for an investor that's made the decision that they want to be able to allocate to the asset class? Like, how should they be thinking about it in the context of their portfolio, and how are investors like thinking about, are they replacing something in equities or alternatives or something else?
Yeah, so crypto has this unique feature in it, which it's a high volatile asset class, historically uncorrelated, and interesting, like the distribution of returns is very different from other asset classes. So what you normally see in equities or other asset classes is that you have like a normal distribution of returns. And this means that more volatility means more risk. And this distribution is normally skewed to the negative. So it means that normally prices would go up in an escalator and will go down in the elevator. So this is how equities normally work. If you look at crypto, the distribution of returns is like a smile. So you have a lot of big positive returns and a lot of big negative returns. You don't have much on the zero, like on the small margin. So you have a big volatility with this like very different distribution that's skewed to the positive side. So this all means that crypto is a very interesting diversifier in your portfolio. So it means that a small allocation to crypto can bring like a very a significant impact in the portfolio, right? I normally like to say that to investors that the difference between the medicine and the poison is the size of the dose, right? So and this chart here will show like how even a small crypto allocation can change significantly the risk-adjusted return of your portfolio, like the Sharpe ratio. So you take like a 0% allocation and then simulate like 1 or 2.5 or 5% allocation, and you can see that there is a big impact in the Sharpe ratio without changing too much let's say the max drawdown, which is in the end like the measure of risk, right? The volatility, it increases marginally compared to the returns, but again, like the volatility is it's very interesting in crypto because of this different return distribution curve. So the measure that we would like to look for is the max drawdown, which is like doesn't increase significantly as you increase your crypto allocation. So this is like normally what we say to investors is that we should look at this as in a small allocation for the long term. There's a big aspect to a rebalance, so it's very significant that investors look for rebalance in the portfolio. So leveraging the fact that we have those significant positive returns to rebalance the portfolio, right, and to come back to a target allocation. So this gives like a very a volatility harvesting aspect to it. So it's very interesting as well, and most importantly, diversified, right? So and we know, like, especially here in the US, because of the Bitcoin ETFs, we've been seeing that most of the adoption have been around only Bitcoin. Most of the conversations have been around Bitcoin. But like Marcelo said, we believe crypto is way bigger than just Bitcoin. And you actually, when you invest when you look for a crypto allocation and you're investing only in Bitcoin, you are shorting this whole optionality, which is like all the other applications in this crypto market. So this is normally our mantra, like what we talk to investors all the time. So small allocation, diversified, and with a long-term horizon. So at least 3 years of investment horizon. And like this is a new asset class. I think it should be seen as a new bucket in your portfolio. But what we see most of the investors is looking at this as in the alternatives pocket, right? And because it brings this diversification.
So what's next? In terms of what's next for crypto in terms of headwinds, tailwinds? Are there certain things you guys have your eye on? And I know you guys do a lot of research. I see it all the time. Like where can people find kind of all the content that you guys are putting out on the sector?
Yeah. So there's a lot of things happening in crypto. Like if you look at the technology side, we're going through what I like to call the broadband phase of crypto. So we're going from like a dial-up connection to a broadband connection, which brings scalability. We're on the verge of seeing like a significant growth in adoption, especially as we have more regulatory clarity in the US. There's Bitcoin also evolving as a store of value asset. So a lot of different things going on. On the ETF side, also, we're expecting to see more clarity from this administration around listing rules. We're having great interactions with the crypto task force at the SEC. I think this is like, there's a lot of things to happen in the coming months. Treasury Department is working on a report to the White House about the crypto policy. There's a lot of discussions in the Congress, so there's a lot of things to happen. We have the Insights Hub at our website, in which we publish a lot of material, and we try to help investors to look at this as an asset class, look at the fundamentals, the investment thesis beyond the speculation, right? So I like to say that we normally act as a filter between all the noise that you see on the internet, on the social media around crypto, and the signal, right? So signal. So what is the actual fundamentals of this technology? So count on us in navigating this asset class over time.
All right, Samir, Lindsay, thank you. Want to open it up in terms of if there's any questions from the group? Happy to kind of field across the group here. Not sure if we have any, but yeah, please.
One point that I want to ask about is correlation with the equity markets. I know the ideal was to have a non-correlated asset class, but it doesn't seem to be panning out. How about with respect to the index and with respect to this, crypto in general?
Historically, crypto has been pretty much uncorrelated, but what we've been seeing, especially after COVID, is that correlation across all asset classes increases. Especially during very macro-driven events, like we saw during COVID, all the assets moving together. Then 2021, end of 2021, and when the Fed started to increase interest rates, all assets started moving together. When they started easing also, so we normally see those moments in which correlations increase, but overall, if you look at the last 10 years, has been mostly uncorrelated. And you can think about it as, if you look at the fundamentals, this technology is very different from the US economy, I would say. Even the impacts of tariffs, if you think about it, it doesn't impact crypto or the digital economy as it would impact the real economy. So the fundamentals are different, so that's why it's naturally the drivers, the risk factors are different. But of course, the big factor that everyone is looking for is macro environment, liquidity conditions, the geopolitical conditions. So all those things, all the asset classes are influenced by that. And that's when we see those moments in which correlations will go up and all asset classes move together. But in general, we believe that this should be seen as a long-term play, right? So you shouldn't measure correlation in those small windows. In the long run, we're seeing this is mostly uncorrelated. And over time, it's normal to expect that this correlation will increase, especially as become part of the traditional portfolios and is seen as an asset class like others. So we expect to see both the volatility going down, but also the correlation over time increasing. So this is a really I think we're really in a special moment in this asset class in which you have high volatility, lower correlation, and most importantly, this distribution of return, which is very interesting from the portfolio standpoint.
All right. Well, thank you, everybody. Appreciate you guys' time. It's great speaking with you. Thank you.
Thank you.
Thank you.